Hi, welcome to Insurance Insider. I'm Jeremy Hallett. Thanks for coming in. Today we're going to be having a conversation about one-way buy-sell agreements. Last week we had a conversation about meditation. This week we're back to insurance solutions. And today we're going to talk about this one-way buy-sell agreement, which is really what happens when you've got a sole owner of a business, whether that's the sole proprietorship, for example, or a single-person corporation, and the different types of unique sets of problems that they face. Okay, so one of these problems they face is there are actually no co-owners to buy the business interest when that owner dies or wants to leave the business. Without co-owners as logical buyers, the owner stands to lose the value and the customer goodwill that have been built up throughout years of hard work and good decisions. That owner and surviving family members lose an important source of income if the person were to die. Faithful long-term employees may suddenly find themselves without a job. You've got vendors, banks, and other creditors that may want to be paid in full or refuse to even extend additional credit without that sole proprietor or that single owner, business owner. Receivables might be difficult to collect. If the business is transferred by will to the heirs, those heirs may not be able to be prepared to actually manage the business because they haven't done it before or they haven't been actively involved in the daily operations of it. Even the executor, that person authorized to help continue that business, can lack the expertise to run the business successfully. And if that executor liquidates the business, the estate may receive only a small portion of its value as a going concern. Still, though, this might be the only option when business assets have to be sold to pay taxes and other expenses. So the moral of the story is too many sole owner businesses, no matter how successful, don't actually outlast their founders because they don't have succession plans in place. So if you are a sole owner of a business or you have clients who are sole owners of your business, pay attention here. When that owner can identify the possible buyer around them, we can really do some cool stuff. Ideally, that person comes from amongst the employees, and then we can create this thing. It's a special version of the buy-sell agreement that's used in partnerships, and multi-shareholder corporations can be adapted for the sole owner situation. And this is sometimes called a one-way buy-sell agreement because only one party, the non-owner, is obligated to buy in the event of the owner's death. So here's how this works. The owner commits to sell, and the purchaser commits to buy the business interest when one or more specified events occur, such as the owner's death. The other two typically are disability or retirement. But let's really go around death. That's actually what I found most sole business owners really only want to deal with the death portion of this, or that's the main one they think about. What the agreement does is it defines the purchase price by specifying either a fixed amount, which should be recalculated from time to time, or actually a formula for establishing that price. The agreement usually provides that the buyer will not assume business liabilities. The executor will use cash from the purchase to pay off the business liabilities as well as other estate expenses and taxes, then distribute the balance under the terms of the owner's will to estate beneficiaries or perhaps a trust for the benefit of the heirs. So the funding of this, the buyer typically purchases a life insurance policy on the owner's life sufficient to meet the purchase obligations under the buy-sell agreement. That buyer is the owner and beneficiary of the policy. Let's just think through that, right? You have a business owner and a key employee, someone's been with you for a while and understands your business. That key employee buys a life insurance policy on the owner. That key employee is the owner and the beneficiary of the policy. And when this is all put together, there's an agreement, and that agreement may actually require that the buyer maintain the policy by paying premiums and notify the owner before exercising any policy rights that might affect the policy value, such as if this is a permanent policy, although normally I see it in term insurance. If they were going to do anything with it, the agreement would stop them from being able to do anything without the owner's express permission. And then that agreement may prevent the owner, that key employee, from disposing of key business assets or assigning them as collateral without the buyer's consent. I'm sorry, we'll go back. The owner being the business owner, cannot dispose of key business assets or assign them as collateral without the buyer's consent. All make sense? So other things that we typically put in these is that buyer has the right of first refusal on lifetime disposition of the business. The owner must first offer the business to the buyer before selling it to a third party during the owner's life, including at retirement. And while this actually restricts the owner's freedom, it ensures that the buyer will not pay the insurance premiums in vain. The buyer can make the purchase in installments, complying with the Internal Revenue Code's installment sale rules, and this could be useful in the event of a lifetime purchase when only the policy's cash value, not the full death benefit, would be available to the buyer, or income being driven by the business if they transferred the business from one to the other. The buyer can also use net income from ongoing business operations to actually complete the purchase. And for the owner, a qualifying installment sale spreads that taxable gain on the sale over the entire payment period instead of lumping it all into one taxable year. So this one-way buy-sell agreement is a really effective way to resolve a myriad of problems that can otherwise plague a one-owner business. The key is finding a willing buyer to complete the arrangement, and ideally that's somebody already employed by or actually really familiar with the business. What we all just need to remember is that if you are the sole owner of a business, whether it's a proprietorship, an LLC, S Corp, C Corp, think through, if you were to die, who would you want to have buy that business so that your family's taken care of, your employees are taken care of, your customers are taken care of, and that everything can move forward. And we do that through a one-way buy-sell. So that's what we're talking about today. Again, this is Insurance Insider. I'm Jeremy Hallett. If you've got any questions or comments, please put them below. Smash that like button, and look forward to having a conversation with you the next time. See you later.